Macroeconomics. Topic 6. Explain how the Federal Reserve and the banking system create money, i.e., the supply of money. Explain the factors that affect the demand for money. Reference: Gregory Mankiw's Principles of Macroeconomics, 2nd edition, Chapter 15. The banking system and the money supply. The Federal Reserve System, also known simply as the Fed, is the central bank of the United States. The Fed has several important functions such as supplying the economy with currency, holding deposits of banks, lending money to banks, regulating the money supply, and supervising the banking system. Most modern economies are based on a fractional reserve banking system. Fractional reserve banking is designed to assure that banks have enough liquid assets reserves on hand to satisfy the normal withdrawals made from checking account deposits. Actual bank reserves equals bank deposits held at the Fed, plus bank vault cash. Both of these assets are readily available to satisfy customer withdrawals or transfer to other banks as customers write checks. The Fed establishes a required reserve ratio, which is the percentage of checkable account deposits that the banks are required to hold as reserves. Thus the minimum required reserves equals required reserve ratio x checkable deposits. Money creation with fractional reserve banking. The money supply is made up of the currency in circulation outside of banks, and the level of checkable deposits in the banking system. To see how banks create money, let's assume we have an economy without a banking system, and this economy has $1,000 in currency, so the total money supply is $1,000. Now suppose someone opens a bank called First Local Bank (FLB), and people in this economy deposit all the money they have at FLB. After $1,000 deposit at the bank, the balance sheet of FLB will be assets FLB, liabilities vault cash $1,000, checkable deposits $1,000. Money supply in this imaginary economy remains unchanged at $1,000. Every cash deposit made reduces the currency in circulation and raises the checkable deposits by exactly the same amount. In a similar way, the withdrawal of cash from your bank does not change the money supply, as your checkable balance is decreased by the amount of your ATM cash withdrawal. What is the reserve position of FLB after receiving the deposit? Suppose the required reserve ratio is 10%. FLB must hold a minimum reserve of at least $100, 10% of the $1,000 checkable deposits. Since FLB holds actual reserves of $1,000, it has excess reserves of $900. The excess reserves can then be used to support the creation of a loan. Suppose FLB now makes a loan of $900 to an existing customer. The change to the bank's balance sheet appears below. Assets FLB, liabilities vault cash $1,000, checkable deposits $1,000 plus $900 equals $1,900, loans $900. FLB's reserves did not change, but notice the checkable deposits have increased by $900, and therefore the money supply of our economy has just increased by $900. Remember, the money supply is the sum of currency in circulation plus the level of checkable deposits. Where did the money come from? It was created by the loan creation of FLB. When banks make loans, money is created. When loans are repaid, money is destroyed. A fractional reserve banking system allows banks to create money through loans. Money multiplier. The process of money creation does not stop with FLB. Imagine that many other banks have opened in our hypothetical economy, and the borrowers of $900 from FLB either withdraw vault cash and spend it with merchants or write a check to someone with deposits in another bank. For simplicity, assume that $900 of currency or checkable deposits ends up being deposited at a bank called Second Local Bank (SLB). Changes in SLB's balance sheet are shown in the following T account. Assets SLB, liabilities. Reserves $900, checkable deposits $900. If SLB holds the 10% required reserve and creates a loan equal to excess reserves, its balance sheet will change by assets SLB liabilities. Reserves $900 checkable deposits $900 plus $810 equals $1,710 loans $810. SLB created an additional $810 of money. Assume the borrowers from SLB deposit the $810 at a bank called Third Local Bank TLB. TLB keeps 10% reserve, or $81, and loans out $729. So, TLB creates $790. This process goes on and on. We can add up all the deposits to determine how much money is eventually created by the entire banking system, as shown on the following page. Bank new deposit new required reserve new loan first local bank $1,000 0.1x 1,000 equals $100 1,000 100 equals $900 second local bank $900 0.1x 900 equals $90 900 90 equals $810 third local bank $810 $81 $729 fourth local bank $729 $72.90 $656.10. $656.10. Totals $10,000 equals $1,000 plus $9,000. The total amount of money created by the entire banking system from the original deposit of $1,000 adds up to $10,000, or 10 times as much as the original deposit original reserve. The ratio of total money supplied to the original deposit original reserve is called money multiplier. The size of the money multiplier depends on the reserve ratio. For instance, if banks decide to hold 20% reserve, money multiplier will be 5. And the sum of new deposits will be $5,000 equals 1,000 plus 800 plus 640 plus. In general, the money multiplier is the reciprocal of reserve ratio. If R is the reserve ratio, then money multiplier is 1R. In our example, R is 10% or 0.1, and so the money multiplier is 1 over 0.1 equals 10. This reciprocal formula means that money supply by the banking system is 1R times the entire banking reserves. So, when the bank's total reserve increase and banks loan out the additional reserves, the money supply changes as follows. Change in money supply equals 1R x change in reserves. The Fed's tools of monetary policy. The Fed has 3 tools at its disposal to alter the money supply: open market operations, changing the discount rate, and changing the reserve requirement. Open market operations. Open market operation refers to Fed's purchases and sales of bonds issued by the U.S. Treasury. These transactions are with banks, public, and firms. When the Fed buys bonds in the bond markets, it pays for the bond by creating new bank deposits at the Fed. These new bank deposits at the Fed add to banks' excess reserves, and can therefore form the basis of a multiple expansion of the money supply through new loan creation by banks. To see how open market operation works, assume the Fed purchased $100 bonds from the first local bank and bank's required reserve ratio is R equals 20%. Changes in the FLB's balance sheet are shown in the following T account. Assets FLB liabilities. Reserves plus $100 bonds minus $100. Since excess reserves have increased by $100, applying the money supply formula, total money supply will increase by $100 by 1 over 0.2 equals $500. To reduce the money supply, the Fed does just the opposite. In summary, open market purchases increase reserves and allow the banks to increase the money supply. Open market sales reduce reserves, thus reducing the bank's ability to create money and therefore reducing the money supply. Changes in the discount rate. The Federal Reserve discount rate is the interest rate on discount loans that the Fed makes to banks. Banks borrow discount loans from the Fed when they do not have enough reserve to meet the reserve requirements. Banks' borrowings from the Fed increase the level of banks' reserves, and these additional reserves allow the banks to create more money. The Fed can alter the discount lending by changing the discount rate. When the Fed lowers the discount rate, it encourages banks to borrow more from the Fed, leading to more reserves in the banking system. These additional reserves will eventually increase the money supply, because of the money multiplier principle, by a greater extent than the increase in reserves. Conversely, an increase in the discount rate discourages banks borrowing from the Fed and reduces the money supply. Lowering the Fed discount rate is expansionary monetary policy, while raising the Fed discount rate is contractionary monetary policy. Changes in reserve requirements. The last tool of changing the money supply is the required reserve ratio. Required reserve ratio determines how much money the banking system can create with each dollar of reserves. When the Fed lowers the required reserve ratio, money multiplier increases as well as excess reserves. These changes can lead to increase in money supply. For example, assume the entire banking system has $1,000 in deposits and the required reserve ratio is 10% and banks are fully loaned up. That means the total reserve in the banking system is $100. Now suppose the Fed lowers the required reserve ratio to 8%, and hence, reduces the total required reserve to $80. With this change, banks find themselves with excess reserves of $20. If banks decide to loan out the entire excess reserves, the money supply can increase by as much as 20 by 1 over 0.08 equals $250. Conversely, an increase in required reserve ratio raises the reserve ratio, lowers the money multiplier, and decreases the money supply. Lowering the required reserve ratio is expansionary monetary policy, raising the required reserve ratio is contractionary monetary policy. There are two problems that the Fed faces in trying to control the money supply. The first problem is that the Fed does not control the amount of money that households want to hold as deposits in banks. The more money the households deposit in banks, the more reserves banks have, and the more money banking system can create. And if households choose to hold more in cash and less in deposits, banks lose reserves and money supply decreases. The second problem is that the Fed does not control the amount of money that banks choose to lend. If banks decide to hold more excess reserves and make fewer loans, the amount of money supply will be smaller. Determinants of money demand. People have several motives for holding non-interest earning money balances. The transaction demand is the main reason why people hold money. This is the money people hold for payments of their regular and expected expenditures such as paying for rent, groceries, movie ticket and so on. Transaction demand is directly influenced with income and price level. Increases in income and prices lead to increases in money demand. Transaction demand also depends on availability of other methods of payments for transactions. For example, the more people rely on using credit cards, the less is the demand for money. People also hold money for precautionary reasons, to make unexpected purchases or to meet emergencies. Precautionary demand, similar to transaction demand, depends directly on income and the price level. The asset demand for money is when people hold money balances as store of value. People may choose to hold money balances rather than other interest-earning assets, such as bonds, because of its liquidity and lack of risk. The disadvantage of holding money as an asset is interest earnings foregone. The decision about how much to hold as an asset, hence, depends on the interest rate. The higher the interest rate, which is the opportunity cost of holding money, the lower the money balances people want to hold. And the lower the interest rate, the higher the money balances people want to hold.